Yeah, thanks for the nice introduction, and good morning and welcome from my side to the CACB this year. It's good to be here again. Normally I'm on a panel. Today I have the honor to make a short presentation about the very interesting questions if digital funds are really the evolution of the fund industry. It sounds quite complex question, and probably it is one. And to answer it in 20 minutes, it's definitely a challenge. So nevertheless, let's start with a short introduction to myself. I'm here in front of you, and two hearts are beating in my breast from a business perspective. The first one is I'm a CEO of the intas.tech, which is one of the leading consulting companies in Germany and in Europe for blockchain use cases. We are owned on one hand side from Plutoneo Consulting. It's a well-established traditional finance consulting company, and on the other hand side, probably not so well known, from the Frankfurt School itself. That means we can combine a very deep know-how in the traditional finance area, plus the research and science aspects from the Frankfurt School. What we do, just to make it short, is more or less an end-to-end approach from the consulting perspective. We are elaborating digital asset strategies, implementing it in the right infrastructure setup, and ensure that it's legal compliant. What's not only so easy like it sounds, but with us you have always the right experts right at your side to make it right. And I think we all heard already a lot of things about mass adoption. Where is it? Why don't we have it? We talk about use cases. What's the right use case for the blockchain technology in the financial space? And I'm totally convinced that the fund industry is probably one of the major cases for blockchain. And this is more or less the second heart in my breast. I'm also here in a role as a co-founder and CEO of fundsonchain, which is a software as a service platform for the end-to-end handling for tokenized fund shares. And perhaps some of you already read the press over the last 3 weeks. It's quite new. We have issued the first real tokenized fund share in Germany, probably in Europe, together with Metzler, which is a huge success. And this is why I'm probably the right one to answer the question if digital funds are really the evolution of the fund industry. Before we start this discussion, I think it's worth to think about what the fuck is a digital fund, and where does it come from? I think you can see regard this topic from several numerous dimensions. So I have to shorten it a little bit, and I have to reduce the scope of my presentation because otherwise 20 minutes are not enough. Therefore, I just look at 3 dimensions. The first one, I just look from a regional perspective to Germany in the next couple of minutes. If we look to the fund types, I just look at actively managed funds. Not on exchange traded funds, ETFs. Why? Because on the actively managed funds, from my perspective, it's still a brilliant product for the masses, but it's too expensive, too inefficient, and probably a little bit outdated. And on the value chain, on the process side, we have huge potential for digitalization. That means regarding the fund dimension, just actively managed funds. And there, I just talk about the first level of an investment fund. That's the fund wrapper or the fund shell. I will not talk about the underlying assets. That means we see there are money market funds and fixed income funds. That's not my case. My case is just to look at the fund shell and what we can do there with blockchain. And the third one is then more or less the process dimension. What processes are potentially interesting for digital funds? From my view, 3 ones: the issuing, the settlement trading, and the third one would be the distribution channel. Having said that, I think a short trip into the regulation. Why is now suddenly digital funds a topic here? I think it's not so new what you see here on the slide. Nevertheless, it has a real and a huge impact for the investment fund industry. From the European Union, we see more and more coming up some regulations here. I mentioned just the DLT pilot regime, because on the trading and the trading area for investment funds, actively managed investment funds, we have, from my perspective, a huge pain points. The sales process is really limited to a primary market. We have no secondary markets there. More than 30% of the total cost of an actively managed investment fund is for distribution. With the DLT pilot regime, we have, from my view, a brilliant opportunity to embed in the infrastructure what we discussed in a panel before for secondary markets, so-called DLT TSS. That means token-based trading places where potentially even fund shares could be traded. That means for asset manager and fund issuers a brilliant opportunity to digitalize their fund distribution and to reduce the cost significantly, what I will show in a couple of minutes. Back to Germany, I think all you are aware of the Electronic Securities Act, which is already, I think, around about 2.5 years in force, and the underlying regulation of crypto fund units, the KryptoFAV. Both new regulations now give the German market the chance to issue now digital investment funds. Why do I say that? And perhaps you are not all so embedded in the fund industry like I am. In Germany, in the history we had, or in the status quo, we have more or less on the left-hand side the situation that we have a so-called CSD market. CSD is a Central Security Depository. That means each and every fund that is issued in Germany has to be registered with a CSD, it's Clearstream Banking Frankfurt. That has some advantages, but also some disadvantages. And every registration process ends up in a so-called global certificate. What is that? In a global certificate, you more or less name the ISIN, the identifier, the number of shares and all this stuff, and it's definitely a piece of paper. That's a reality in which we are living. You send, as an issuer, this piece of paper to Clearstream, they store it to their vault. Based on that, we have even there a limited process regarding the settlement. It's all very centralized, and if you now bring in your knowledge and know-how about blockchain, could be perhaps a use case, isn't it? If we now combine this technology possibilities with a regulatory framework, you move over to the right-hand side and become now more and more a register-based market. That means we don't not need any longer, based on the eWpG and the crypto fund unit regulation, a CSD and the paper-based global certificate. We can now register funds within an electronic or crypto security register. That sounds not so interesting, but just from a perspective, and I'm more than 2 decades in the global fund industry, that's for Germany really, from my view, a big milestone to disrupt more or less the actually monopoly of Clearstream and to reduce the cost that we are currently paying for global certificates and for the transactions there. If you go now one step deeper, and I don't know if you all were already here for the panel, the colleague Julien from BNP Paribas mentioned that already. If you now imagine we have the regulators set up, we can issue funds on chain, and we can register them in a DLT-based infrastructure. That's not the only case. On top of that, that's in the middle, we can automate more and more processes. And the first one is the settlement process. It's a peer-to-peer communication which is really feasible on blockchain to ensure a highly efficient settlement. You now say, okay, well, who cares? Yeah, but the reality we are living in currently in Germany, in Luxembourg, as well as in Ireland, for a mutual fund that you buy today, you have a settlement time anything between T+2 and T+4. That's totally outdated. I think you would all agree. With the blockchain technology, you would be able to realize it with T+0, but we all know we have no cash lag. on one hand side, and probably the liquidity management of the asset manager will not agree with the T plus null settlement, but we can reduce it significantly. On top of that, other smart contracts for digitalization will enable to heal and to make painful processes much more efficient. Some examples could be here the calculation of tax figures, the calculation of trailer fees, or the calculation of some reporting figures. That means it's not only the registry, the disruption of the global certificate, it's also the opportunity to digitalize step by step the value chain of issuing, trading, distributing and settling funds. So I would say, and I hope you would all agree, we have a good use case there, isn't it? Could be regulatory, it's compliant. From a technology perspective, it seems to be feasible, and we have some aspects we could make better. But is that enough for really being a game changer there? Or is it more a flash in the pan? What do we need? And we all asking, when will the mass adoption happen? What do we need for mass adoption? Mass. And what do we have in the current market situation in the fund industry? A lot of mass. We have only, just in Germany, we have current, and these figures are more or less from the June and July 2023. Currently, in the actively managed investment space, investment fund space, we have around about 4 trillion euros assets under management, only in Germany. Around about 20 trillion euros assets under management in Europe, and around about 60 trillion assets under management globally. And I think we would all agree that's a lot. That's a mass that could really be good enough and a good basis for a mass adoption. But just that there is volume does not mean that there's a migration feasible and that will be adopted to blockchain. I agree on that. What do we need on top of that? I think we need not only a technical use case, we don't need only a mass, a volume, we also need a business case. And what makes a business case happen? I think two aspects. First one, the economical driver. That means the client must become the middle of the spotlight. We have to end up with the technology-driven discussions. If it's what I heard in the panel before, it's one ledger, it's two ledger, it's permissioned, it's Polygon, it's X, Y, Z. I think for the investor, retail as well as institutional, that don't care. They don't care about that. They care about their pain points. And why do investors today buy funds or buy no funds? Because fund is a product, from my perspective, which is perfectly fitted for the masses. The volumes reflecting this in a way that's without any argument against it. But if you look in on the retail side, what does happen there? And the illustrative value chain here shows a little bit the reality. And in reality, in Germany, in Luxembourg, in Ireland, there are much more intermediaries in between, different departments and different banks, still additional intermediaries. It's just an illustration. And on the left-hand side, you see the investor. And on the right-hand side, you see the Menco, the issuer. The distance is quite huge. And if I go to retail investors, why don't they buy, the younger generation, an investment fund? It's not so sexy. It's really expensive. And expensive means the average total cost ratio of a mutual fund is anything between 1.5% and 3%. And if you then make a revenue or from 5 or 6%, that's really huge. And 30% of these costs are related to sales. Just the sales channels are really expensive. Other big piece of the cake is the portfolio management, and the rest is then back and middle office activities. On top of that, for the younger generation of retail clients, it's not so attractive because perhaps they want to have more and more, and we are all here crypto related, we are in the bubble, we are token enthusiasts, and I think that in a world which come up with more and more tokens, even the fund industry must offer for the next generation of retail clients something which is able to come into any wallet so that the younger generation of clients is really interested in buying this product because it's professionally managed, It's highly secure, it's highly regulated. It's a very good product for masses. If we move over to the wholesale side, the institutional investors, we have a little bit different pain points. Again, the cost side, even there is the cost pressure still higher than on the retail side. But on top of that, they miss very often transparency. And we heard it from the colleagues from BNP and JP Morgan before. We have, if you look in a global view, and this process we are talking about, the buying and selling this fund shell, this fund wrapper, is a so-called transfer agency business. And if you look into the global transfer agency business, big players have 7, 8, or 10 different platforms in place. The investors miss totally the transparency in their transactions, cross-border transactions. They miss transparency in their current tax figures, the status of transactions. That's are really pain points for an institutional investor. We could potentially heal with blockchain. So let's end it up. If we all agree that the regulatory framework is there, the technology makes more or less this use case feasible. We do see here the mass of volume, and we see the pain points. I think we could agree that a potential business case is behind this use case. And if we look now one step deeper, what is the economical business case, potential business case? Again, German view. And these figures that you can see here on the left-hand side, and I define in the footnote the tier 1 and tier 3 asset manager size, this are not a fairy tale. This is reality. That means an asset manager, more or less a mutual fund-oriented asset manager, as here mentioned, with around about 150 billion euros assets under management, pays by now for transactions, the mentioned global certificate, round about 50 million per year recurring. A smaller one, tier 3 I called it, with round about 10 billion assets under management, pays round about 1 million, because the pricing model is scaling with volume, so that you pay a little bit more, a little bit less if you have a higher volume with Clearstream, for instance. That means that's huge. And finally, this cost pays the investor finally. That makes this product very unattractive. I think overall, if we say we have 150 or 250 basis points overall cost, that's not so much per investment fund, but nevertheless, every euro counts to make your products, if you are an asset manager, more attractive in comparison with the competition, isn't it? The second one is my piece of takeaway here, market efficiency. I mentioned already that by now we settle mutual funds, institutional funds with T+2 to T+4. And definitely, and this is worth to mention, we had the great honor to issue 3 weeks ago this first transaction with Metzler Group. In the next couple of weeks, a third-party institutional investor will step into this share class. We can there define and fulfill the value proposition to settle T+1. And that means from a technical perspective, T+1, T+null is no longer a dream, it's reality. We could fulfill this value proposition. It depends then on the integrated back office systems which are still in the old world. We are just talking, just to remember again, just about the wrapper and the fund shell. And finally, another big cost block is the distribution. I mentioned already as small as 30% of the total cost. Definitely always more than 30 basis points you pay as an asset manager for your distribution partners, very often more than 50 or 60 basis points. And if you then imagine DLT pilot regime is in place, we see more and more token-based trading platforms, we can reduce this distribution cost significantly under 10%. Long story short, the question was, digital funds are the evolution of the fund industry. I would say no. Digital funds, from my perspective, based on a platform like fundsonchain, are the basis for the investment fund industry to survive in the future, to become again attractive for the next generation of customers on the retail side and institutional side, and set more or less a perfect framework to bring this product again to the masses and ensure that blockchain is perfectly fitted for the fund industry. Thank you.